Thank you guys for joining us. We called this meeting today to discuss lowering the federal interest rate. This will be our biggest cut since March of 2020. Although we're excited to see the inflation rate get closer to our targeted percentage of 2%, taking this action will help us to reach it faster. GDP has continued to increase, jumping up 2% from last quarter. However, there's another problem that is on the rise. According to the U.S. Department's Bureau of Labor Statistics, the nation's adjusted unemployment rate is 4.2%, a 0.4% increase from August. To put it into perspective, this is a 32% decrease from the number of jobs created last August. We expect it to rise to 4.4% by the end of this year. This continues to occur at this rate, we expect a recession within the market. Making this decision to lower the rate by half a percentage point will be a huge incentive for businesses to grow and hire more workers. We're ensuring that we reach the Fed's dual mandate and beat the cooling job market without taking on the risk of moving too fast or too slow with our fiscal policies. I'm going to hand it off to Kevin now.
So in order to meet our dual mandate of price stability and maximum employment, we believe that lowering the federal funds rate by 0.5% is best for the economy. We will do this by influencing the federal funds rate by taking actions that shift the supply and demand for loans in the market. Our primary tool will be the IORB rate, which will serve as a price floor for the federal funds rate. This will create a minimum interest rate that banks will charge before loaning funds overnight. Banks can deposit excess funds in its account at the Fed and earn IORB rate. Part of the expansionary policy will be to lower the IORB rate. Tool number 2 is the ONRRP rate. This is overnight reverse repurchase agreements, and Fed borrows from financial institutions overnight and pays them interest on the loan. Tool number 3 is the discount window rate. Banks offer collateral and get a loan from the Fed, typically set higher than the federal funds rate and acts as an upper bound for the federal funds rate. Part of expansionary policy will be to lower the discount rate. And the tool number 4 is the open market operations, where the Fed buys and sells government bonds. So in this case, part of the expansionary policy, we will buy bonds.
Federal funds rate target by 50 basis points to 4.75 to 5% has many implications for the economy. The federal funds rate largely affects the prime rate, which influences credit cards, auto loans, and other lines of credit. Therefore, the lower federal funds rate can greatly influence consumption, which can boost economic activity throughout the United States. Beyond household consumption, the lower federal funds rate target also incentivizes business investments, creating more jobs, which will be beneficial in lowering the unemployment rate further than the 4.2% recorded in August of 2024. Returns on business investments paired with reduced cost of borrowing increases companies' profitability, which will encourage the purchase of stocks of companies that are performing well. Another market that was noticeably affected by the federal funds rate hikes in past years was the housing market, as mortgage rates soared to highs in recent years. Though they've been on the decline due to anticipation of the rate cuts, the decrease in the federal funds rate is likely to improve accessibility to mortgages by causing a decrease in mortgage rates. Generally, the fall in the federal funds rate is expected to produce positive effects in various sectors of the economy. This decision was made with available data over the years, with the Fed's dual mandate of maximum employment and low and stable rate of inflation being prioritized. Thank you.